Hello and welcome to Class 8 Personal Finance. My name is Garrett, and in today's video, I want to talk about four good types of DIY investors. The reason why I want to talk about this is in part I had a conversation with a friend the other day, and the conversation went one from target date funds and then going all the way to factor investing and what the factors are. And I kind of had the thought, I was already thinking about talking about types of investors or levels of investing. And my thought is let's put together some models of what an investor might look like, what a good DIY investor might look like, based upon how much involvement that investor might want to have with the portfolio in the first place, what the knowledge level is, how much they really want to learn about spreadsheets, etc., versus just letting it sit there and doing nothing with it until seeing it once a year or perhaps even less than that. So let's go over four good types and just a basic overview of what these investments might look like. And I'm going to start with the simplest and just go from there. The first one I have listed here is a target date fund. A target date fund investor simply chooses target date funds available in employer accounts and IRAs, plugs in the necessary contributions, and leaves it alone, not interested in the underlying mechanisms. And if you look at the channel homepage, you can see target date funds right about there. So I've got a longer video on target date funds that's about half an hour. Let me give you a brief summary. A target date fund, a good example of a target date fund might be this one, the Fidelity Freedom Index 2050 Investor Class Fund. What do I like about this one? One, I'm uh, of the age where 2050 is the age when I retire. You might be different, and so you might want to plug in, go to Fidelity's website, type Fidelity uh, Freedom Index, and then it's going to show you all these other years. And if you don't see your year on there, just plug in a multiple of five that's close to your retirement date, and it'll come up with what you want there. But I do emphasize that has you want to have the Fidelity Freedom Index fund because the index funds in there are going to have much lower underlying expense ratios. You can see that this one here has an expense ratio of 0.12%. That's the amount that you're paying per year of the overall fund. And if you go to something like the Fidelity Freedom 2050 fund, see how that's a little sneaky? It doesn't say index in there. Well, it's a completely different fund. I mean, it's still got the target date qualities in there in terms of getting safer over time, but note the expense ratio 0.75. Let's go back here. I'm going to try to keep from getting too complex here, and I'll show you what's inside it. So you look at the composition right here. I'm in the wrong one. I said I wasn't getting too complex. Go back, go back, go back. Not going back far enough. Okay, let's try this. Don't you love redirects and how they mess up your back button? Okay, so we're in the index fund now, and we can look at the composition and see how much simpler that is. Maybe you don't think that's simple, but let me elaborate. So you have 53%, 53.6% in US equities. That's just a normal US index fund. You have 35% in non-US equities, just an international fund right here. You have about 10.65% in bonds. And this fund gets a little complex with the bonds. It has three different bond funds in here, and that's okay. I think this is actually a pretty good mix of bonds. Not a perfect target date fund, but you know what? No target date fund is. One thing that you're giving up with a target date fund is the ability to customize everything to exactly what you want. But if you don't want to customize things, if you really just want, hey, give me a solution that I can work with, that I can just plug money in and leave it alone, hey, this might be for you. I can give you, for example, Fidelity Freedom. Let's plug in 2030 because I want to show you how this looks over time. So for someone who's retiring in about 8 years, it's going to get a lot safer. In fact, the expense ratio actually goes down a little bit, oddly enough. It's 0.66. But let's look at the actually went up because I put Fidelity Freedom. not index. See how that works? It's tricky. Index 2030. That was my mistake. There we go. Oh, by the way, if you're doing this by yourself on Fidelity and you're not in an employer account with this is like in an IRA, make sure it says investor class because you go to those upper ones and you might run into contribution, might run into a minimum to invest. We'll check that in a sec, just for kicks. I was trying not to make this too complex. Note that the expense ratio here is 0.12, nice and low. And if you look at the composition, it's going to have less in stocks because we're trying to get safer as we get towards retirement. In US equities, it's 36.22 rather than 50 something. Non-US equities 24.17, and the amount in bonds has gone up significantly, almost all the way to 40%. A normal bond index fund, you got some long-term treasuries in there. And they've started to add some treasury inflation protected securities, which is nice. And it has a lot more in the international bonds. So the whole idea is that as you get closer to the date that's named in the name of the fund, it starts getting safer. So it's doing a lot of that management for you. And that's all assuming that you're just a normal person who's retiring on a normal date. You don't have anything too complex going on. You don't have too many strong preferences about what's in the portfolio, that kind of thing. This may very well be a fund that's good for you. Kinds of people that might fit in this kind of fund. Oh, by the way, I'm going to add Vanguard Target Retirement Funds among my normal recommendations for this one. And if you go into the official spreadsheet, and that's always in the description of every video, you can find its tab that's called Comparison of Target Date Funds right here. And I've got actually three right here: Fidelity Freedom Index Funds, Vanguard Target Retirement, and then the Schwab Target Index Funds. Again, with Fidelity and also with Schwab, make sure it's got index in the name or you're looking at the wrong one, not one that I recommended. Let's go back here to the main table here. Kinds of people that might fit in this kind of fund. Career starters. I'm especially thinking about school teachers. School teachers who are straight out of university and becoming student teachers, or getting out of student teaching and becoming full-time grade school teachers. Annuity companies prey on you. They absolutely prey on school teachers. And if I'm not too insulting, um, when I say this, but I'm not the first person to say it, that if you were looking for the money, if you were like super financially savvy, maybe you wouldn't be becoming a school teacher because school teachers don't go into it for the money. I want to say that in an honorable, um, complimentary way because people who go into school teaching, they're not looking for the money. They're looking to serve kids for the most part. And hey, we love you. Um, and these annuity companies like TIAA will go after school teachers who don't know anything about financial planning and go, oh, let's do this annuity thing. It's really safe. And man, these annuity companies make a killing off you. You're 22. You don't need an annuity. You should have some aggressive stuff going on, even if you don't feel particularly safe about it. Get educated, and then okay, you can take that risk because you're not going to need that money until you actually retire sometime in your 60s. Rather than going with an annuity, then go, oh hey, it's super safe and it's growing at a really slow rate, and it's not really serving you well. It's serving the guy who sold you the annuity. Deployed military or people without PC access. Do we still call these things PCs, like these things on which we do these operations that aren't iPads? I don't know. But deployed military, where you might not have internet access to actually manage things when you need to manage things. You might just want something that's just automatic. And you know what? Another example I'm going to put here is, I'm just going to do it now. Thrift savings plan. Whoa, that's not the cell I even clicked, guys. There we go. Thrift savings plan L funds. Because within the thrift savings plan, which is the 401k for federal employees, including military, it's called a thrift savings plan, and you have the L funds, which are basically those target date funds. And for example, there's L 2050 for my age, that kind of thing. And I really, really, really like them. I was just telling a guy who just went out with the military for the first time. You know what? Just plug into the thrift savings plan and pick the yellow fund. I didn't want to give them a whole lecture on fund portfolio or anything like that. Just pick the yellow fund. You're good. And then another kind of person, people who don't sit at computers for a living. I'm thinking folks at my own employer, truck drivers, warehousemen, etc., who don't want to figure out how to make a three fund portfolio. Use a target date fund. Nothing wrong with that. You'll pay a little more in fees, but perhaps the behavioral errors that you might be committing by trying to manage it yourself would be outweighed by just having a target date fund where it's much more difficult to make those kinds of errors. And then the actions required, there's a reason I have it like that. It's adjust contributions as needed to meet goals. Make sure you're actually contributing enough such that you're going to have enough at the end. Next type of DIY investor in this row is the three fund index investor. So we're going to talk about how to construct a three fund portfolio really fast here. A three fund index investor is able to gauge one's own risk tolerance, choose among available providers, that is, brokerages and fund providers, and produce a three fund index portfolio in each available account. So I'm just talking about you have say a 401k and an IRA. Within the 401k, you put a US stock fund, an international stock fund, and a bond fund. And then you have an IRA on the side. And within the IRA, you have a US stock fund, international stock fund, bond fund, and just keep those portfolios the same. If you can do that twice, once within each account, you're a three fund index investor. You can pull this off. And I think most people should be able to do this. And a lot of people who have knowledge going beyond this still just go with the three fund index portfolio because they want to keep it simple and they still want to save the fees on what would otherwise they would choose a target date fund. So how do you build a three fund portfolio crash course? So I've set this one up here and I'm actually going to reconfigure it a little bit. Let me zoom it in a little bit. Can I go 150 here? I'm going to go 125. There we go. That's good. So here we have, and this is not treasury. This is just total bond market here. I'm going to word wrap that. There we go. So you have two basic asset classes between stocks and bonds. And within the stock side, we have US and I'm going to call this foreign because the US is a nation. US stocks and foreign stocks. Now, these tickers are for ETFs, but I think for a lot of three fund index investors, they might prefer the simplicity of mutual funds because it just makes it easier to have automatic contributions. So again, I'm trying to keep this simple and not get carried away with complexity. So I want to highlight three funds here. And the classic index investing provider is going to be Vanguard. In as much as I have issues with Vanguard in terms of their tech support and all that, it's just kind of the archetypical provider. So typical three fund portfolio at Vanguard with my little twist. I'll explain in a moment. We have VTSAX, which is Vanguard's total stock market index fund. Real classic stuff. It was incepted in 2000, so it's not as old as the S&P 500 index fund. And it's basically trying to buy every single US stock weighted by how much of that stock in dollars is on the market. It's what we call market capitalization. So if I say market cap or market capitalization, you can think of it as just the dollar value of the company. And when a stock fund is market cap weighted, the amount of stock that is in that fund is based upon how valuable that company is, how much value of that company is out there in the market. So in this case, Apple is the number one company within the US market, therefore is the number one company within the Vanguard Total Stock Market Index Fund, and on from there. You can follow this up with something like this. And this is my little twist. Vanguard Developed Markets Index Fund Admiral shares. Most index investing gurus would not tell you to do this. They would tell you go with the Vanguard Total International Stock Index Fund I don't like that because of some of the emerging markets that are in there. I don't want to put China in. I don't want to lead people to go invest in China or Saudi Arabia or whatnot. I say stay with developed markets um, that, for the most part, are free countries. Hong Kong's an exception. Sorry, but yeah, Hong Kong's in there, but because it's a developed market in terms of the economic um, freedom aspects. But I think this is probably the best international index fund that's out there in terms of just plain old market cap weighted indexes. It's got an expense ratio of 0.07, which is nice and cheap. VTSAX is 0.04. And then the third fund here would be Vanguard Total Bond Market Index Fund. Bit of a misnomer. It's not really the total bond market, but I'm not going to get too much into that. It's the mixture of both treasury and corporate bonds, and it's got a nice expense ratio of 0.05. Another thing you're going to notice about these three funds is if you're just starting out, they have $3,000 minimums on each of them. So, hey, what are you going to do about that if they have $3,000 minimums? You could go the ETF route because all three of these have ETF share classes. You could also go with one of Vanguard's target date funds just until you get to however much you need in order to build the index portfolio with these three funds. The other aspect is, let me come back here to the spreadsheet, is, let me find it. Da-na-na-na-na. Where'd it go? Three fund portfolios by provider. I have this page on the spreadsheet. And just take note that Fidelity and Schwab also have similar funds. Not exactly the same, but similar. And these six do not have a minimum investment. So you may, if the minimum investment really is a concern for you and you just want to build a fund portfolio outright, I can definitely recommend Fidelity because I'm a Fidelity customer myself, and I've been very happy with their tech and their customer service. So you could just take these three mutual funds, build a three fund portfolio, and call it a day and not have to worry about the minimum investment. But I point out Vanguard because they are the classic index firm. Index funds are their bread and butter, whereas index funds are not the bread and butter of Fidelity. Fidelity is all about actively managed funds, and index funds really they're in it in order to bring in customers, and eventually they kind of want to bring you towards the things that make them more money. But if you don't listen to that and you just go with these funds with no minimum investment, and in fact their fees are cheaper, um, then you should be great. So if it were me and I were starting over and I had to do a three fund portfolio, I would go with those three Fidelity funds, just knowing what I know. Let's go back to our four good types and talk about this a little bit more. Who's Is this suitable for nearly everyone? Yeah. There's a lot of folks who could potentially go into these other two rows that we'll talk about and just choose not to because, hey, this is a good enough portfolio and I want to do other things with my life. I don't want to worry about tilts. I don't want to worry about factors. I just want a very simple three fund portfolio that's already nice and diversified. Hey, go for it. Personal finance is personal. Um, Another aspect, people who have had time in target date funds and now want to exercise more control. Hey, you think your risk tolerance is different than what's in those target date funds, and you want to, um, actually choose the stock to bond ratio. You actually want to choose the U.S. to international ratio. So those are the kinds of people. The actions required. Um, Oh, and I lost this last one here. People who are recovering from being with high fee advisors. I'm going to talk about advisors probably in my next video, but my story includes basically running from a financial advisor I had signed up with who was very, very high fee. After I discovered how to build a three fund portfolio, I had to start, like what I was talking about, with actually the Vanguard Star Fund is where I started with Vanguard. I moved on to a target retirement fund once I hit $3,000 in it. And then once I was able to hit those minimums, Then I was able to get into a more like a three fund portfolio approach. Um, Actions required, you're going to have to determine a stock bond ratio, US to foreign stock ratio, and rebalance. Let's talk about those first two right now. So I have a three fund example here, and there's a few rules of thumb to think about. First off, you've got to think about your stock to bond allocation, and there's a couple of things you can think about. One is age minus 20 or age minus something in bonds. When I was starting out, I just used aged in bonds because that was the advice of Vanguard's founder, John Bogle. He was still alive at that point. And so, I was like 22 at this point, and so I made my bond percentage 22. And so I have by the way, you can download the spreadsheet and then it'll start calculating things for you. Um, so I made my bond percentage 22 and my stock percentage 78. And let's just go with that for now. Back in the day, I also made my US to foreign stock ratio 70/30 based on some stuff I read on the bogleheads.org website. Let's go ahead and put our tickers in here. VTSAX, VTMGX, and VBTLX. That'll work. And so by doing this, if you do the math yourself, basically 0.78 times 0.70 equals 0.546, and you convert that to 54.6% and so on. Let me explain this a little bit. But going back to this stock and bond percentage here, I'm more convinced that age minus 20 in bonds is the appropriate amount of aggressiveness for most people. Some will say 120 minus your age in stocks. That's another approach. I like age minus 20. I think it's will prevent more behavioral errors in terms of the ups and downs of the market. So, for example, I happen to be 37. By that formula, I would be 17% bonds by that point. And when someone turns 65, that person would then be 45% bonds and 55% stocks, and then keep on going from there. There's different systems that you can go with that you can look up. Sometimes it's called a glide path. If you look up asset allocation glide path, you can find more. You could also just plagiarize a target date fund because take note. Let me go back to Fidelity Freedom 2050 was Fidelity Freedom Index 2050. See, it's confusing. Yeah. Fidelity Freedom Index 2050, and note that it is only 10.65% bonds. So according to Fidelity's recommendation, maybe you should make this in the spreadsheet. If you are retiring in 2050, like I am, you would make this only 11% and your stock's 89%. But okay, this is a call that you have to make on your own, depending upon your overall situation. In terms of your US to foreign ratio, I suggest 60/40, and the basic explanation for that is that the 60% of the US 60% of the world stock market is the US. So you make that basically market cap. Are there nuances to that? Yes, because note I put a developed markets index fund in here, which doesn't include emerging markets. So it's not the entire international market that we're putting here. But I like 60/40. I think it's enough US bias, and the US seems to be an overpriced market right now. So I think 60/40 is basically a good simple answer. Some people will tell you to make this 70/30. Some people even tell you to make this 100 and 0. And their rationale is that the US already has enough foreign economic exposure because for example, where does Apple make their iPhones? China. Okay. Where does Apple sell iPhones? Everywhere. So they would say, hey, you already have foreign exposure within the US market. Don't bother with foreign stocks. And my response to that is, right, but these foreign companies also do business with us. So why wouldn't you just diversify that out anyway? And you get the currency diversification in there as well. 60% is still there. So you have, a lot. If you're a US investor, you still have quite a lot within your own currency. So I like 60/40, but there's a lot of smart people who would disagree with that. Warren Buffett, for example, John Bogle, both, um, s- well, John Bogle said just go 100% US. Warren Buffett still says just go 100% US. But hey, I'm allowed to disagree. You're allowed to disagree. Personal finance is personal. So that's the three fund portfolio in very simple terms. Let's move on to the next one, an intermediate index investor. Let's zoom this out a little bit. So, an intermediate index investor is able to do everything the three fund index investor does and then look beyond the standard three fund portfolio to customize exposures. Must have conviction about tilts to withstand periods of underperformance. And so you would have this three fund portfolio here. That's not a well, that's three fund list of three fund portfolios. So you take this three fund portfolio here, and you might add something to it. What could you potentially add? I made this one back in the day on the site, and it was a four fund example. I said, hey, you could split out your bonds. You could say, hey, have a separate treasury bond fund and a separate corporate bond fund if you feel like you need to adjust the bond exposure in your portfolio. That's one thing you could do. I also, um, there's another video where I talk about emerging markets. Let me zoom in on this part right here, make sure it's um, visible. Let's talk about the tilts that we could possibly pursue. Some folks will pursue an emerging markets tilt. That's not something I recommend, but that's something that some folks do right there. The issue with emerging markets, one of the issues is that China is about 33% of emerging markets right now. When I started this channel, or rather maybe about a year ago, was about China was about 40%, and they've had a pretty bad market tumble. So my decision to um, get out of China seems to have been right, or just really good slash lucky timing. So maybe that's not my skill. Maybe it's just luck. But some folks will say, hey, I'm going to add a little extra to emerging markets because they're cheaper and they're riskier, and that risk is compensated. Not my thing, but it's an example. Another tilt would be an additional small cap value fund. So uh, if you could say this one right here, AVUV, Avantis US Small Cap Value ETF, and then AVDV, Avantis International Small Cap Value ETF. Full disclosure, I own both of these Avantis funds within significant amounts in my portfolio. And funds like these from Avantis or funds like these from Dimensional Fund Advisors, this is their US Small Cap Value ETF. This is their International Small Cap Value ETF. Funds like these will try to target the factors other than the market factor. Factors are mathematical phenomena that explain stock market returns. One of them is market, which is what you're literally already getting with an index fund. And then you have small size, you have value, so underpriced stocks, you have profitability, and you have low investment. I'm not going to try to elaborate on those too much. Wrong video. I have a factor tilting video right there. Look at the factor tilting video. I explain more of that. So you definitely want to view that video or read a lot more about factor tilting before you do this, because here's the thing. You do any of these things, you tilt to emerging markets, you tilt to small cap value, you tilt to industry sectors, for example, real estate. Others were probably doing energy, tilting to energy because, hey, people are underestimating how much we're going to need oil and gas. The green energy revolution isn't working, something like that. And the issue with tilting is you have to have conviction. You have to have conviction over the long term in order for this to be sound, because what if you're wrong over the next year, over the next 5 years, over the next 10 years, and you give up? You're like, well, that was a bad move. And then you sell it and you go back to having had a three fund portfolio in the first place. that means you would have done better with just a three fund portfolio rather than sticking with it because you thought it was going to do better over the long run. If there's a chance that you are going to abandon the strategy over the course of, I'll say 10 years. I mean, if you're not committed to that tilt for 10 years, don't bother. Just do the three fund portfolio. It's a sound portfolio. This is what I'm talking about when I'm saying, hey, people who could go beyond that three fund portfolio, who have the knowledge to go beyond that three fund portfolio, often don't because they know they're not going to be able to hold on to that tilt for 10 years. They see that underperformance going on and they know they're going to, sell out and just go back to that three fund. You'd might as well just stay in that three fund in the first place. Um, so I am heavily tilted to small cap value to the point that I'm actually in the following row. But if you're not going to have that conviction to even have a 10 to 15% small cap value tilt in your portfolio among your stocks, then this would not be the row for you. For whom is, for what kind of people, grammar. For whom is this row appropriate? For whom is this row appropriate? People who are comfortable with math and spreadsheets, because note the three fund example right here and how I produced this spreadsheet. Here's a four fund example. Okay, there is no example here for the small cap value tilt. So if you don't know how to like add rows on here and then make the percentages work to have a US small cap value fund and an international small cap value fund, and then calculate all those percentages out to what they should be, and then oh yeah, you got to stick the dollar amounts in there, and then you have to potentially put share prices into Google Sheets and all that. Okay, that's all very interesting. I like doing it. I have a huge spreadsheet with all of my ETFs and all of my accounts that integrate everything out. If you don't know how to do that, if you don't want to know how you do that because oh, I'm not a nerd and all that, okay, I'm not going to insult you. I'm also going to say don't pick this intermediate index investor road. Don't pursue these tilts and just go with the three fund portfolio because it's what you know how to do. And that's great. All right. Um, I'm already in that tab, O'Hara. So if you're not comfortable with math and spreadsheets, this isn't for you. If you don't read investing books for fun, if you don't read investing forums for fun, this one's not for you. Stick with a three fund portfolio or a target date fund. If you're not comfortable buying and selling ETFs, you would not want to pursue this one because there just aren't a whole lot of plain old mutual funds that do this. At least those that one don't require you to go through an advisor or some sort of institutional path, or like a TSP mutual fund window, which I reviewed in another video. It's just an oddball way to do this. And then finally, if you're not comfortable researching funds outside of normal market cap weighted index funds, you actually would have to, you know, have me or someone else point these out to you, then this probably isn't for you. You would want to just stick with that three fund portfolio. And let me emphasize, the three fund portfolio is great. All right, I don't want to try to knock it down and go, ooh, this is shiny, this is nice, you should do this instead. No, if this isn't something you can stick with, it's not for you. So the actions required to do something like this, we kind of did that already. You have to already know how to build a three fund portfolio. And then you have to figure out how to mathematically tilt it and then be consistent. You have to figure out how much tilt you want. You would have to be able to research those tilts and be able to justify them. If you're not familiar with the term FAMA French five-factor model, don't pursue a small value tilt yet until you really understand that. And then you're still going to have to rebalance the portfolio and your contributions annually. And oh, by the way, you might not be able to pursue a strategy like this with just your 401k. And so you're going to have to combine your 401k account and your IRA account and then make sure that the tilt accounts for the entire portfolio. If that sounds too complex, good. All right, it wouldn't be for you. I have it that way in mind because I like spreadsheets. This stuff, makes me interested in it. If you need a book about this, and I'm going to, I'll address this in the next one, um, and then you'll see why. So the final one would be the full-on factor investor. This this is where you get really complex. A factor investor is able to do everything the intermediate index investor can do, has significant conviction about long-term viability of the factor models being pursued, willing to deviate significantly from the market portfolio and withstand long periods of significant underperformance without budging from the plan. A lot of that is also true of the intermediate um, index investor when you're talking about even a small tilt. But I'm making this over here because I'm making this a separate category in that this guy isn't using mostly index funds. This guy is using mostly funds from Avantis or Dimensional, that kind of thing. So not merely the small cap value funds, but also the large funds from those providers as well. Or in some cases, some folks will even use exclusively the small cap value funds, which is, yeah, pretty insane. So an example, here's what I wrote: globally diversified portfolio made up of funds of factor focused products. Providers such as Dimensional and Avantis, the investor should know how to integrate these with employer accounts that may not have the same kinds of funds available. I don't want to dig too much into this because, one, I fear like I'm going to lose most of you. And two, I don't want to make it too attractive to folks who should, you know, not be doing it. But imagine using here's a portfolio that I've seen folks use: 50% AVUV, 50% AVDV. Okay, again, full disclosure, I'm heavily invested in both of these funds. I'm not 50% each. um, I'm actually 40% of my US stocks are this, 40% of my international stocks are this. That's the level of my small cap value tilt. It's heavy to the point I would say I'm a factor investor. But that's definitely not for everyone. Some would do something like that within the dimensional funds. These providers also have large cap funds too. And within those large cap funds, they're still pursuing those factors. The large cap funds wouldn't do the size necessarily to that extent, but they would still pursue the value, the profitability, the investment. And sometimes momentum plays into that as well. Again, I don't want to get too much into that. Kinds of people that might fit here. If you're aware of the podcast Rational Reminder, and there's a online community forum associated with that, then you would already know about this. So that this might be for you. This also would be for professional financial advisors who manage their own portfolios. What you need to do, pretty much all of the above, you need to know how to do, and then you have to research, research, research. And I would, if you are interested in this, I would not even pursue this until you read a book. And I didn't pop it up. Let me do it now. Um, Andrew Birkin, Larry Swedrow. Factor investing book. And it should pop up. That's the one with the orange cover. Your complete guide to factor investing: the way smart money invests today, by Andrew Birkin and Larry Swedrow. I've read through this book. There's a few appendices that I think I still need to go through. Um, delightfully, delightfully nerdy stuff. This one's delightfully nerdy as well. The Incredible Shrinking Alpha, second edition, and it's got this cover that looks like an 80s sci-fi horror movie, which I think is pretty funny. Uh, Written by the same guys. Larry Swedrow's listed as number one on this one. Larry Swedrow does a lot of podcast interviews and such. So if you catch his name in a podcast or something like that, definitely listen to it because he's sharp. But again, let me kind of wrap this up. Because one, I don't want to say is that there's some sort of ranking where the investors on the bottom are better investors than the investors on the top. That is not what I'm saying at all. What I am saying is if you you need to know the kind of investor that you are and then put yourself in the correct category in order to have the best chances of success. If you're the kind of investor who should be in a target date fund because you're liable to commit behavioral errors, don't go into factor investing because you're going to dump it the moment these factors start underperforming. Value had a long period, like a decade long period of underperformance that ended basically when the pandemic started. Um, so you don't, if you had started factor investing when that period of underperformance started, then you would have been in serious trouble. You would have sold everything out, and you would have missed out on some normal gains that you would have gotten from that three fund index portfolio, that kind of thing. So, if you're just starting out with this investing thing, there's absolutely nothing dishonorable about starting out as a target date fund investor, learning some things, and then figuring out if you want to be a three fund person. Once you're a three fund person, maybe you want to stop. Maybe you want to go into being an intermediate index investor after you've done a significant amount of research on what kind of tilt you want to pursue. I would say small cap value, maybe 10 to 15% to start out with and not take too much risk uh, just yet and feel it out. But eventually, you're going to have to some conviction about maintaining that tilt. If you're not going to have that conviction and you are liable to give up on that tilt when it starts underperforming, you're going to want to just stick with a three fund portfolio, and there's nothing dishonorable about that. In fact, it might be the most rational and come out with the best result because it prevents behavioral mistakes. And then finally, with the factor investing, it is definitely not for everyone. And again, these are four good types of DIY investors. Why do I say DIY here? I think my next video is going to be on levels of financial advice. And once you start getting into financial advice, you start talking to professional advisors, and there are good professional advisors who will put these kinds of people, target date fund type people, into factor products. And that might kind of sound a little scary. And it's all going to depend on the level of advice that you're receiving. Because if you're going to an advisor who doesn't manage your money and says, hey, here's a 20-step list of what you need to do to rebalance your portfolio, and here's how much you need to contribute, and hey, let's talk about it again in 2 years, and you're on your way. You get 3 free phone calls with the fee, and here's a $1,000 invoice or something like that, which is still going to be cheaper than someone who manages your money and you pay that person a percentage of your portfolio every year or something like that. Again, I'll talk about that in the advice video. I've got an outline for it, and we'll go from there. Another reason for this video is to highlight by highlighting good types of DIY investors. I want to try to exclude certain types of investors who are just not really investing, but more speculating. If you can stay within these categories and be disciplined in whichever category fits your personality, fits your life situation, then your chances for success are going to be a lot greater. And I think that's where I'm going to end it. My name's Garrett for Class 8 Personal Finance. If you liked the video, help out the algorithm, subscribe, or whatever you feel like is necessary or good to do. And I will see you in the next video.